Good morning, good afternoon, and good evening. Welcome to the Acard Reader's Briefing, the podcast that turns a full issue of a major magazine into a 30 to 60 minutes audio pack. Today, we are bringing you a reader's guide to the August 17th, 2026 issue of Barron's. Our core themes today include the following. The cover features Vanguard Chief Executive Salim Ramji under the title The King of ETFs. Vanguard entered the exchange-traded fund market late, but low fees, index strategies and scale carried it into the lead, while its flagship S&P 500 fund passed $1 trillion in assets. Ramji also added cash management, fixed income, wealth management and private assets to the growth plan. The cover therefore asks how an asset manager built on a low-cost reputation can expand into higher-value businesses while preserving the trust investors have built over many years. First, as Wall Street approaches record highs, how are long-term rates, government debt, war and energy prices accumulating tail risk? Could the market's short-term brightness conceal emerging pressure from fiscal policy, inflation, and consumption? Second, will roughly $1 trillion of global artificial intelligence spending, together with even larger long-term capital commitments, become broader productivity and profit growth? If returns arrive more slowly than expected, how much pressure will financing chains and market valuations face? Third, with inflation, taxes, interest rates and market volatility in view, how can investors use cash buffers, diversification, inflation protection, annuities and low-cost funds to preserve long-term purchasing power? Fourth, do the valuation discounts at Uber, Medpace, BJ's Wholesale Club and Yeti reflect fears that the market has exaggerated or operating risks that are still not fully priced? Fifth, from software growth, artificial intelligence customer value, and a recovery in commercial food service equipment to film intellectual property and programmable chip contracts, what operating evidence leads research firms toward a buy judgment? Sixth, how do chief executive purchases, executive ownership, and activist filings change governance and market signals? Can those trades be treated as a guarantee of company value? Taken together, this issue of Barron's follows capital as it moves among macroeconomic risk, artificial intelligence infrastructure, household asset allocation, company fundamentals and governance. It presents the reasons prices may rise while preserving a cautious focus on debt, earnings quality, financing cost, and the ability to deliver over time. Next, we turn to the article briefings in today's magazine.
Section 1. Macroeconomics, Policy and Global Capital Flows. This section follows war, energy, inflation, employment, fiscal pressure, income distribution, and cross-border capital flows as they enter market pricing and move through bonds, currencies, commodities, corporate earnings, and household consumption. 1.1. Wall Street bathes in the light as darkness creeps in. Stocks were being bought aggressively while bonds were warning of major economic and inflation risks, even as volatility remained near its 2026 low. Record indexes showed that the artificial intelligence story had become real technology sector profit, while decade-high bond yields showed that inflation, debt and deficits had not disappeared. The equal-weighted S&P 500 outperformed the benchmark, suggesting broader market leadership. But job losses, weaker retail sales and low consumer confidence left the economy looking less bright. Government debt could reach $40 trillion. The 30-year Treasury auction yield had climbed to a quarter-century high, and the war with Iran had pushed oil toward $90 a barrel. Corporate earnings and long-term yields could rise together because stocks were looking at current cash flow, while bonds were pricing 30 years of inflation and debt supply. Wall Street was bathing in light, but darkness was already creeping in at the edge of the picture. 1.2. Review and preview markets, companies, deals, and the week ahead. The week opened with new Iranian demands, renewed attacks on shipping, and rising oil prices. After July, inflation eased to 3.4%. Technology stocks rallied, and the S&P 500 reached a Thursday high before fading on Friday. Nvidia and major asset managers announced $500 billion for artificial intelligence infrastructure. Bank of America added another $250 billion. Intel increased its share offering to $20 billion, and Reddit was set to join the S&P 500. AstraZeneca and Bristol-Myers Squibb merger talks collapsed, while the Los Angeles Lakers changed hands for $12.5 billion. The coming week would test retail earnings, July housing starts, Federal Open Market Committee minutes, and manufacturing and services purchasing managers' indexes. War, policy, artificial intelligence financing, consumption, and housing data were all updating the same economic picture. 1.3. Why soaring profit margins might not be so sweet. Profit margin growth by itself did not say very much. In the second quarter of 2026, the blended net margin of the S&P 500 reached 15.7%, while after-tax corporate profits stood at 12.4% of United States gross domestic product. The central question was whether the gain came from business growth or from moving money that had gone to wages into profits. Margins built on layoffs and a falling labour share could invite wage pressure, employee loss, mean reversion, and political intervention. Artificial intelligence was already running this experiment across the market, and Oracle had cut about 21,000 jobs while citing artificial intelligence deployment as one cause. Investors could compare a company's margin with its own history and its labour share with past peaks. When margins rose as labour share fell, extra profit and workers' losses were the same money. Only sustained improvement in revenue, customers, unit costs, compensation, and operating cash flow would make the margin look durable.
1.4. China's capital flight is fueling global AI. China posted a record $1.2 trillion trade surplus last year, yet official foreign exchange reserves did not rise. Rhodium Group estimated that 1/2 to 2/3 of the surplus went into overseas securities, increasingly artificial intelligence stocks and corporate bonds, meaning China was indirectly helping to finance the United States artificial intelligence boom. Beijing imposed a 20% capital gains tax on offshore trusts and insurance products used for foreign investment, but taxation did not erase the return gap between domestic and overseas assets. 10-year sovereign bonds yielded only 1.7%, property and equities offered limited appeal, and provincial subsidies for competing manufacturers pressed down domestic profits. Central and local government debt may have exceeded 200% of gross domestic product, so higher rates would raise debt service, while completely stopping outflows could strengthen the renminbi and threaten manufacturing. The result was not a one-way flight of capital, but a loop in which the world bought Chinese goods and Chinese investors sent part of the proceeds back into global markets, with data centers and technology companies becoming the new destination. 1.5. Is the K-shaped economy a thing anymore? The troubling K-shaped economy appeared to be easing, at least for now. In July, card spending by lower-income households rose 5.4%, faster than spending by middle and higher-income households, while after-tax wage growth exceeded that of higher-income Americans for the first time since December 2024. Stronger hiring and changes in withholding left more cash in household hands. Full credit card repayment became more common, and inflation-adjusted savings remained above 2019 levels. Because consumption represented about 70% of gross domestic product growth, those changes supported a steady second half. Yet the convergence in wages and spending was a cash flow improvement, not an equalization of stock and housing wealth, and higher gasoline prices could quickly absorb the gain. Short-term convergence did not mean the K-shaped structure had been cured.
Section 2. Artificial Intelligence, Technology Infrastructure and Market Structure. This section examines artificial intelligence capital spending, the transformation of computing power into a financial asset, financing structures, the delivery of profit, and disagreement in market pricing. 2.1. The AI boom's big test. The artificial intelligence boom had changed the income statements of suppliers, but not yet those of buyers across the economy. Since late 2022, net margins had risen in technology and communication services, while healthcare, consumer staples, energy and materials had been flat or lower. The Magnificent Seven had margins of about 25%, compared with about 10% for the other 493 companies in the S&P 500. Roughly $1 trillion of annual global artificial intelligence spending still had to leave visible evidence in lower costs, higher efficiency and new revenue. Investors expected tangible returns by 2028, so quarterly results over the next 2 years needed to show improving margins outside technology. If returns remained concentrated in Nvidia and the hyperscalers, free cash flow would come under pressure. Companies could cut other investment in hiring, and the gap between valuation and earnings could force repricing. The real test was whether a broad range of companies could turn purchased models and computing power into their own profits. 2.2. The numbers get larger inside the AI financing scramble. Artificial intelligence construction was moving from internal technology company budgets into the wider financial system. 5 large technology companies had made $2.7 trillion of future commitments. A new $500 billion platform would bring private capital into data centers, and Intel planned a $20 billion stock offering. Nvidia wanted graphics processors to be treated as investable assets with useful lives approaching 10 years, and it could provide residual value support for as much as 25% of selected deals. Intel, facing negative free cash flow, rising capital expenditure, and $50 billion of debt, was using equity to expand processor and manufacturing capacity, while its diluted share count had already risen 22%. Debt financing added interest and repayment obligations. Equity financing diluted existing shareholders, and project finance depended on customer contracts, equipment life, and future rent. The cycle could work while final demand for computing was real. If demand fell short, utilization, rents, residual values, and debt service would all come under pressure.
2.3. Why the bulls can win the AI war against the bears. Bulls and bears agreed that earnings growth was exceptional. They disagreed about what supported it. Bulls pointed to market breadth, consumer spending, capital spending, and second quarter S&P 500 earnings growth of 50.4%. Bears warned about circular financing and big tech capital expenditure, arguing that the profits used to justify valuations were the artificial intelligence boom itself. The article then treated computing power as a new asset class. CME Group planned futures based on NVIDIA graphics processor rental prices so companies could lock in costs and hedge exposure. The debate would eventually leave two sets of evidence: corporate profit and the price of computing. Expanding profit with stable forward rental prices would support the boom, while falling profit and weaker rental rates would strengthen the case for excess capacity. 2.4. The hidden red flag in Wall Street's price targets. Analyst price target dispersion across the S&P 500 had reached a 10-year high, with the average gap between the highest and lowest targets at 62.5%, and technology stocks showing the widest disagreement. Research found that strong disagreement made the consensus target less reliable, and that highly dispersed targets could precede weaker returns even when the average upside looked attractive. The gap could reflect genuine valuation differences, reluctance to cut targets, or stale estimates that had not been updated. A practical measure compared the high-low spread with the consensus target, and readings above 30% began to raise a red flag. Dispersion did not merely show a healthy range of views, it could mean that the average had stopped representing any coherent forecast.
Section 3. Asset Management, Funds, Inflation and Retirement Allocation. This section reviews fund flows, low-cost asset management, gold and crypto assets, inflation protection, options and retirement risk, while comparing the trade-offs among return, liquidity, taxes and long-term security. 3.1. 3 ways to protect your portfolio from volatility. With September and October historically volatile, retirees did not need to predict the top. They needed to manage whether they would be forced to sell in a decline, whether their holdings were too concentrated, and whether income could continue. The first step was a cash buffer covering at least 1 year of portfolio withdrawals, while money market funds still yielded about 3.5%. The second was diversification inside equities through equal-weighted funds and international stocks. The third was to consider a fixed indexed annuity that traded some upside for downside protection and lifetime income. The 3 methods addressed forced selling, concentration and longevity risk, with the shared goal of keeping living expenses on schedule through market volatility. 3.2. How to keep inflation and taxes from eroding your savings. Money market funds yielded about 3.5%, only just above 3.4% inflation, so taxes could still leave savers losing purchasing power. Longer maturity treasuries offered higher yields, but could lose value when rates rose. The article favoured shorter maturity Treasury inflation-protected securities, while noting that inflation adjustments could create taxable income before the cash was received. To beat both inflation and taxes by a wider margin, investors had to accept some risk through real estate investment trusts, energy pipelines, and income stocks whose dividends could grow with prices. There was no magic answer. The choice was to exchange the after-tax purchasing power risk of cash for some combination of bond price, credit, and business risk. 3.3. Vanguard is the new ETF king. It is not stopping there. Vanguard's assets had risen from $9 trillion to $13 trillion, and its flagship S&P 500 exchange-traded fund had become the first such fund to reach $1 trillion. Low costs and an investor-friendly reputation allowed a late entrant to catch BlackRock. The new management team was building growth around financial advisors, model portfolios, active bonds, a short-term treasury fund, cash accounts, digital advice, and a gradual move into private markets. The challenge was to preserve low fees and client trust while spending on technology, improving service, and entering higher value businesses. If the company could apply its low-cost approach to cash savings, advice and fixed income, investors and Vanguard could continue to benefit together.
3.4. Do not mourn the Fed put. Make this trade instead. The article argued that corporate earnings were a stronger market put than the Federal Reserve. As long as profit kept growing and margins remained healthy, stocks could withstand more volatility. Around the Jackson Hole meeting, it proposed buying an S&P 500 exchange-traded fund call option expiring on September 11th, using less capital to express a bullish view and limiting the maximum loss to the premium. Low volatility reduced the option cost. Strong earnings provided the direction, and the policy meeting supplied the event window. Yet the option still had a strike price and an expiry date. If the fund did not rise in time, the buyer could lose the entire premium, and earnings could not eliminate short-term risk.
3.5. ESG funds delivering eye-popping returns. United States environmental, social and governance funds recorded their first quarterly net inflow in more than 3 years. Most of the new money went into low-cost passive exchange-traded funds focused on grids, wind, clean energy, solar power and storage. Artificial intelligence data centers were increasing electricity demand. Aging grids needed investment, and geopolitical tension had made energy security more important. Yet, some products had no sustainability mandate or exclusion screen, and still owned natural gas utilities. Active funds continued to lose money, while passive funds gained it, showing the importance of fees and transparency. A fund name could not replace a review of the actual holdings and screening rules. A fund name could not replace a review of the actual holdings and screening rules.
3.6. Crypto's gold bug. Tether bought more than 27 metric tons of gold in the first half, putting it near the leading central bank buyers. The company used gold to diversify reserves and hedge inflation and dollar weakness, and its continued purchases could become a meaningful source of marginal physical demand. Tether also issued tokenized gold, turning ownership of physical metal into digital rights on a blockchain, while second quarter holdings rose 9.5%. Gold diversified the reserve base, but introduced metal price, liquidity, custody and redemption risk. A stablecoin issuer was now buying large quantities of bullion while issuing on-chain claims to gold, bringing traditional reserves and digital finance into the same structure.
Section 4. Company and Industry Fundamentals. This section focuses on growth, valuation, competitive advantages, operating efficiency, and catalysts at individual companies and within specific industries, asking whether market discounts reflect exaggerated fears or operating risks that remain underpriced.
4.1. Uber stock looks cheap. Here is why. Robo-taxis still represented only about 1% of United States rides, and the market may have overreacted to the threat they posed. Uber remained the leader in ride-hailing and food delivery, served more than 200 million monthly active customers, and was building an autonomous vehicle network that did not depend on Waymo alone. Second quarter revenue rose 11%. Gross bookings increased 22%. Adjusted earnings per share grew 35%, and cash and investments exceeded debt. The stock traded at about 17 times expected 2027 earnings, below utilities and the S&P 500. The real variables were the Waymo relationship, Tesla competition, and whether a planned fleet of 120,000 robo-taxis could be deployed. Even so, Uber was unlikely to be displaced as the industry leader.
4.2. This healthcare stock could jump nearly 40%. MedPace designed studies, recruited volunteers, ran trials, evaluated results, and submitted findings to the Food and Drug Administration for small and mid-sized biotechnology companies. It raised revenue guidance, reported 18% growth in earnings before interest, taxes, depreciation and amortization, 37% growth in earnings per share, backlog above $3 billion, and an 80% repeat customer rate. Faster artificial intelligence-driven drug discovery could send more companies into Phase 1 trials and expand the contract research market. The risks ran in the opposite directions. The trial process could become fully automated, or the expected wave of drug discovery might not arrive. The share price opportunity depended on faster bookings, fewer cancellations, and continued margin improvement.
4.3. Can BJ's be more like Costco? The case for buying the stock. BJ's Wholesale Club had just under 300 stores and was far smaller than Costco, but it traded at about 20 times expected earnings, roughly half Costco's 42 times. BJ's offered less crowded stores, vehicle loading, manufacturer coupons, and package sizes aimed at mid-size families, while collecting steady membership income with high renewal rates, modest debt, and recent buybacks. Its problems were weaker brand recognition, an uneven record of expansion in the South and West, and roughly twice Costco's number of stock-keeping units. The Dallas-Fort Worth expansion, assortment reduction, and August 21st earnings report would test the improvement case. BJ's might always trade at a discount to Costco, but the analysts still saw more than 20% upside. 4.4. Yeti sell-off may be an opportunity. Yeti beat second quarter adjusted earnings expectations and raised its full-year profit outlook, yet the stock fell more than 12% because United States drinkware sales were weak and expenses rose. Drinkware produced about half of sales and grew only 2%, while coolers and equipment grew 16% and international sales increased 19%. The stock traded at about 14 times earnings, compared with 23 times for the consumer discretionary sector. The opportunity rested on higher guidance, faster growth in coolers and international markets, and a price that had already absorbed part of the concern. The risks were fashion-driven competition, higher marketing and delivery costs, and whether revenue growth would translate into operating profit.
Section 5. Research Report Extracts. This section brings together 5 research report extracts on software growth, artificial intelligence platform value, a recovery in commercial food service equipment, film intellectual property, and programmable chip contracts, while preserving the conditions and execution risks behind each rating. 5.1. Datadog, the Rule of 60 and High-Quality Growth. Benchmark Equity Research reaffirmed its buy rating on Datadog and a $330 target. Second quarter revenue grew 35.6%, and the free cash flow margin was 24.9%, producing a combined 60.5% under the Rule of 60. The measure did not reward growth or profitability alone. It asked whether both could appear together. After the stock retreated from its post-earnings high, the firm still called Datadog a preferred name in high-growth infrastructure software and software as a service. The next quarter's revenue, free cash flow, customer retention, and product usage would show whether this high-quality growth could continue. 5.2. GoDaddy's Airo artificial intelligence platform could raise customer lifetime value. After meeting GoDaddy management, Oppenheimer became more confident that the Airo artificial intelligence platform would raise customer lifetime value. 70% of Airo customers added a second product, compared with 50% of GoDaddy customers overall. The company planned to place Airo inside the domain purchase flow, allowing a customer to move from a domain into websites, email, marketing, and other services. A broader product relationship could increase wallet share and make renewals more stable. Management still expected $1.8 billion of fiscal 2026 free cash flow and a normalized margin above 33%. Oppenheimer nevertheless kept a perform rating, separating confidence in the platform's operating effect from a more bullish stock call. 5.3. Middleby, a recovery opportunity after simplifying its commercial food service equipment business. Seaport Research Partners believed Middleby was close to finishing a long simplification and returning to commercial food service equipment as its core business. Second quarter sales rose 8.3%, but inflation continued to pressure margins, and the share decline was viewed as a buying opportunity. The company retained an established restaurant customer base, products, balance sheet, and cash flow, while kitchen replacement demand was tied to energy savings, automation, and lower labor requirements. The recovery sequence was business simplification, renewed core sales, customer adoption of new equipment, and margin recovery as costs eased. The firm reiterated buy and set a $145 target.
5.4. Lionsgate, film intellectual property and television deliveries drive earnings growth. Michael and the housemaid gave Lionsgate a strong start to the year. The company planned to balance large tentpole films with lower budget productions and to keep developing reusable franchises such as The Hunger Games. Michael would enter its first pay television window in the fourth quarter, allowing theatrical, premium video on demand, and licensing revenue to continue unfolding. The television business expected more episode deliveries in fiscal 2027, supporting revenue and profit growth. The research firm rated the shares outperform with a $17 target, but box office performance, production cost, release windows, and television delivery timing would still determine the actual earnings path. 5.5. QuickLogic, a lower growth target, but contracts and diversification still support the buy case. QuickLogic reported results and guidance below expectations. Its 2026 revenue growth target narrowed to 70 to 80%, while third quarter revenue was expected to remain flat, making the full-year result more dependent on the fourth quarter. The support came from continued execution of a government contract worth as much as $89 million, expected new funding before year-end, and a growing pipeline of development kit customers. Needham cut its target to $20 but kept a buy rating. Near-term contract execution, medium-term productization of design modules, and longer-term customer diversification still supported the case, but any delay in contracts, funding, or orders would raise execution risk sharply.
Section 6. Corporate Governance, Insider Trading, and Activist Investing. This section records chief executive purchases, activist filings, and ownership by newly appointed executives, showing how changes in holdings can signal confidence, governance pressure, and alignment without replacing independent analysis of company fundamentals. 6.1. Pfizer's chief executive closes the insider week with a rare purchase. After Pfizer reported second quarter results, Chief Executive Albert Bourla made his first open market purchase of the company's stock, buying 38,000 shares at $26.34 for about $1 million. Two directors had also bought about $2 million of stock, while the chief financial officer made a smaller sale on the same day. Unlike shares received through compensation, the purchases used personal funds and occurred after the earnings release. The rarity of Baller's first purchase attracted attention, but insider trading data showed only a change in ownership. It could not replace analysis of drug sales, research progress, cash flow, and company value. 6.2. Activist filings, UMH properties, and position changes at 4 companies. Eras Asset Management reached a 5% stake in UMH properties and wrote to the board seeking a full review of strategic alternatives, including a sale. It estimated net asset value at $21.25 to $24.25 a share. During the same period, Orbimed, Situational Awareness, Equinox and Gilda Healthcare reduced positions in biotechnology, data center, energy and medical device companies, although most retained meaningful stakes. 5% was an important disclosure threshold. Crossing it required investors to report not only position size but also investment purpose. The filings did not guarantee a future sale or acquisition, but they recorded the latest changes in ownership and governance pressure. 6.3. 2 newly appointed Berkshire executives buy company stock. 2 newly appointed Berkshire Hathaway executives used personal funds to buy company shares in the open market. Chief Financial Officer Charles Chang bought 2 Class A shares at $765,000 each, while General Counsel Michael O'Sullivan bought 488 Class B shares at about $512. Berkshire offered no employee stock plan and granted no stock compensation even to senior executives, so managers who wanted to become owners had to buy shares like ordinary investors. The transactions came early in their tenures and aligned their economic exposure with outside shareholders. Ownership alignment, however, did not guarantee that every decision would match every shareholder's preference.
All right, we are now ready to enter today's main program. Before we do, please like, save, and share this episode so that other people who need it can also see today's content and become better versions of themselves. Thank you. You can now use the timeline in the video description or the pinned comment to find the articles that interest you and listen to them in depth.